So on the face of it, we can somehow relate all these disapprovals and delays to Viceroy's reports. Because of that, all these disapprovals are taking place, more or less, is what we can conclude. So Viceroy is a US-based short seller, and they came with a report on Vedanta on July 9th, 2025. And I'll try to cover the crux of Viceroy's allegations, and then we'll see how far we're able to substantiate it. Okay, so before that, Vedanta Resources is the parent company which is based out of UK. It was listed earlier, but then it got delisted in 2018. Vedanta Limited is the Indian subsidiary of Vedanta Resources. Vedanta Limited is listed on Indian stock exchanges. And Viceroy's contention is that Vedanta Resources is a parasite that is draining its host, Vedanta Limited, of all its resources. Okay, parasite as in it's draining its host, and Vedanta Limited is a dying host, it seems, and Vedanta Limited exists only to serve Vedanta Resources, according to Viceroy. Why? Because Vedanta Resources, the parent company, is heavily debt laden. It has huge amount of debts, and therefore it is using Vedanta Limited to reduce debts, to fund its operations. So how is Vedanta Resources using Vedanta Limited to reduce debts and fund its operations? It's through massive dividends and huge brand fees given by Vedanta Limited to its parent Vedanta Resources. So to explain this, given Vedanta Resources has more than 56% stake in Vedanta Limited, Vedanta Limited to that extent has to pay dividend to Vedanta Resources, which is massive and consistently massive throughout the years, all right? Because Vedanta Limited maintains its image as one of the highest dividend-paying companies in the country, okay? And so what is the problem if it pays dividend? The problem is, according to Viceroy, Vedanta Resources is heavily debt-laden, as we discussed, and this huge dividend that it gets from Vedanta Limited is used to reduce Vedanta Resources debts. So is that evident? Yes. From $9 billion, Vedanta Resources debts have come down to $5 million out of the money that it has used from Vedanta Limited. Now dividend is not a problem. The problem is these dividends are not given out of the profits generated or out of the cash flows that are available, but it is borrowed and then given as dividends. So that is where the problem is. So do we have data to substantiate this? We'll see later, all right? Now, what is brand fees, okay? Brand fee or royalty fees means the fee that the subsidiary company pays to the holding company to use holding company's name, logo, brand, trademark, goodwill, reputation, or other intellectual property. Now, supposing I'm appointed as a subsidiary of a company, I take up being a subsidiary of a particular company. So instead of me having to start fresh, start from zero to establish myself in the market, to gain investors' trust, customers' trust, support, loyalty, investors' support, the traction that I need to establish right from scratch, right? For my product or service, whatever it is, the trust I need to build. So if I'm able to establish myself as a subsidiary, or the holding company establishes me as a subsidiary, I inherently get all that benefits. The brand, the trust, the goodwill, customer support, customer loyalty, right? So when you see Chai Point, you know that they give very good tea, right? So that is the brand. So what happens is automatic goodwill, trust, brand itself gets established, right? As a consideration for the inherent benefit that I get as a subsidiary, I pay a fee to my holding company. That is called as brand fees or royalty fees. Now, similar to dividends, again, dividend is not a problem, but you're borrowing debts and giving dividends out of it to your holding company so that the holding company can reduce your debts and finance your operations is where the problem is, all right? So similar to dividends, high brand fees is something that Vedanta Limited is paying to Vedanta Resources, its parent company, according to Viceroy. So what Viceroy says is there are no operations as such because of which such high brand fees is being paid by Vedanta Limited to Vedanta Resources. In a report that came in, around 14 times higher brand fees is what Vedanta Limited is paying to Vedanta Resources. So why? It is nowhere comparable to the peers in the industry. Why so much brand fees? And this money is extracted from Vedanta Limited by Vedanta Resources, again to reduce debt of the parent company and to finance the operations. And this does not come out of profits or cash flows, but out of borrowings, is the contention of Viceroy. So essentially what Viceroy's contention is that Vedanta Limited is not generating enough cash flows or profits enough to give such massive dividends to its parent company or to give such high brand fees to its parent company, but it is borrowing such amounts in the form of debts, in the form of stake sales, and passing over it to the parent company in the name of dividend and brand fees. And that is how Vedanta Resources debt has come down over the years. So Viceroy's further allegations are that the entire group is financially unstable, operationally compromised. ESL Steel's capex fund is a total fraud. They're hiding lump sum contingent liabilities. They are faking asset values. The auditors are not fit for the purpose. The balance sheet is propped up by impaired assets. So how Viceroy sees Vedanta is that it's a portfolio that is riddled with financially unviable assets, undisclosed liabilities, systematic fraud, and profound government failure. Okay, so let's now go on to see why Viceroy says that the assets are fake values. They're given two examples to substantiate this. So Talwandi Sabo power plant that we discussed, TSPL, Punjab state-owned power utility is the only client, and $200 million payment is pending from them to be received by Vedanta. And this $200 million is on hold as of now, and Vedanta has reported this revenue as non-cash revenue. What Viceroy says that when you're not going to receive this revenue, why are you inflating your revenues to such extent? Now, the revenue is just on hold. It has not been cancelled or declined. So it's okay if it is shown as non-cash revenues in the profit and loss, right? Second example that Viceroy has given is Vedanta Resources subsidiary, Konkola Copper Mines. Now this filed for liquidation in 2019 and it is continuously loss-making. And still Vedanta is showing Konkola Copper Mines as asset in its balance sheet, as a fictitious asset in its balance sheet. Okay, and therefore inflating asset to such extent. Now this one looks reasonable and logical, that when you know they filed for liquidation and they're continuously loss making, so why are you showing it as a fictitious asset? So also what Viceroy says is that the revenue expenses are systematically accounted for as capital expense. So it inflates revenues as well, it inflates assets also to such extent. Okay, so what Viceroy says is that if the demerger is approved and if it goes through, non-operational subsidiaries are going to come into existence. These subsidiaries right from the very beginning will be laden with debt. Viceroy says that after demerger, Vedanta will simply transfer all liabilities, all debts of holding company to the demerged entities. That is, non-operational subsidiaries are going to come into existence if this demerger goes through. So Viceroy's contention is that the debts that are currently projected in Vedanta can actually be so much more than what is actually presented. Okay, and that Vedanta's book value is a pure fiction. And according to Viceroy, Vedanta's gross debt has increased only by $1 billion, but Vedanta's net debt has increased from $3.7 billion in 2021 to $9.9 billion in 2025. That is 3 times it has grown. The gross debt has only grown by $1 billion, but over the same period, net debt has grown by 3 times, and the interest cost has also doubled. Okay, from 7 to 8%, within 5 years, interest cost has doubled to 13 to 14%. So who are they paying this interest to? So what Viceroy says is that Vedanta doesn't have much assets to sell. It cannot get more debt. It doesn't have much cash to pay off. There's no working capital to unlock value, and that book value is a pure fiction. So Vedanta doesn't have the capacity to cover interest cost of Vedanta Resources, and assets of Vedanta India are overstated by billions of dollars, according to Viceroy. So another allegation by Viceroy is that Vedanta Resources aggressively bought more and more shares of Vedanta Limited's shares, and they used the same Vedanta Limited shares, kept it as a pledge to get more loans. Okay, Vedanta Limited's more and more shares were got aggressively by Vedanta Resources using Vedanta Limited's funds, and the shares bought, that is Vedanta Limited's shares that were bought, was used as a pledge to get loans. And $122 million was written off from the books of Vedanta Resources just like that, and it was never paid to Vedanta Limited, is another allegation. So when Viceroy people were asked, given that S&P and Moody's have upgraded Vedanta in the past 12 months and ICRA and CRISIL have given AA rating, so what Viceroy had to say is that our process, our methodology is very much systematic, very we do it on our own. We make our research go through many stress tests, and it's months of research, and after that they come up with such reports, and they don't have to rely on, and they don't rely on other agencies for credibility purposes.
So this is continued in the next part. Like and share for more such videos, and let me know your feedback in the comments.